offices of Beta2, and I'm joined by Lane Clark, the Managing Director of Beta2, who are a foreign exchange specialist. It looks like we live in interesting times, Lane. 2010 looks like an interesting year. Can you talk us through your own thoughts on how it's shaping up?
Interesting, yeah, I certainly agree with that. Here at Beta2, we believe there are multiple opportunities out there for investors to make percentage returns this year, but it's imperative that they're flexible with their investment approach. Now, we've seen some massive shifts within the market over the last couple of years, and we believe the volatility that this has brought is here to stay. And this is why we would say it's imperative to be flexible in your trading approach in 2010.
There's been a big shift in asset classes over the past couple of years, a move away from things like hedge funds. Talk us through 2008, 2009 and how that relates to today.
Okay, well obviously with the onset of the credit crunch, like you said, it changed the markets dramatically. Now in 2008, what we witnessed was what we would term as a risk-off year. This means investors generally, they flock away from asset classes that they believe to be fairly risky. Equities, hedge funds, property, and even higher yielding commodity type currencies. And this is why we've seen the demise of these asset classes. Equities, in fact, in 2008, FTSE was down 30%, hedge funds 18%, and properties 16%, just to name a couple of asset classes. Now, like I said, the commodity currencies, obviously, they deteriorated in value dramatically as well. And the main beneficiaries that year were dollar and yen. Yen, in fact, was up 40% against our own Great British Pound. And this is why we would say, regardless of the market climate, there's always opportunity to yield returns. Now, if we change that to 2009, Q1, we've seen a continuation of this trend. But after that, what we've seen was a risk-on year, where investors are willing to take that little bit more risk. On the back of that, the FTSE actually turned around and it was up just under 18% on the year. Gold, that was up 25%, and silver, 51%, because people were willing to take on the extra risk. And this obviously shows how quickly these markets can change, as that's quite a turnaround from 2008.
Okay, so back to 2010, and the risk is there that we maybe head into a double-dip recession, and a lot of people concerned about that. If they are, how can they cope? How can they mitigate that risk? Okay,
well this brings me back to obviously how I started. It's imperative to be flexible in your approach. Yes, you should have the macro climate in mind, but you have to be prepared to shift with market sentiment. Now, if people believe there will be a double-dip recession, then it will go back to risk-off, where we think equities will go down, hedge funds potentially will go down, property and emerging markets will both go down as well. What you should look to invest in times like that are things like the US dollar, the Japanese yen, things that are perceived as lower risk, lower yielding currencies. Okay? Now, if people believe the confidence of 2009 will remain in the markets and the trend will continue, then once again, we would believe a portfolio should consist of equities, growth-related hedge funds, potentially emerging markets, and higher yielding commodity type currencies. And this is why I say it's key to be flexible, because as and when the market sentiment changes, the investor's portfolio has to as well. My advice to any investor out there, expect the unexpected, because if the last 2 years are anything to go by, if we use them as a benchmark, it makes sense to.
So, Lane Clark of Beta2, thanks so much for your time this morning. It was fascinating learning about how you think 2010 is going to pan out. Thanks again for your time.
No problem.